Hello, everyone, and welcome. This is Nick Liebert with Exit Realty. Hope you are doing well. Just going to be testing a few things here, making sure audio and such is up. Happy Saturday, everybody. Want to make sure you guys can hear me.
Yes, we can.
Wonderful. All right, guys, please mute yourselves on the way in. We're going to get started here in just a minute. We have a lot of people on this Zoom and coming on the Zoom this morning, so we are very excited to have you as we switch into the 12 o'clock hour. Now it is 12:01. I'm Nick Liebert with Exit Realty. I am your host today, but I am not your presenter. We have a lot of information to cover. We have Don Meadows from Regions Bank, who is a friend to our brokerage and has done some wonderful transactions with our agents, who's going to be our guest speaker. We're going to switch the Zoom host mode over to him in just a moment, but I did want to welcome you on behalf of all of us at Exit Strategy Realty. This is the latest in our round of consumer education. We do a consumer education series every month here at Exit in one of four key focus areas. That is health and wellness, personal finance, community and charity, and of course then real estate. So today we are in that real estate space as well as personal finance. We know that a lot of you are trying to get into your first home or investment property, and one of the biggest struggles to do that is going to, of course, get that down payment. And there is a lot of help out there for you. There's a lot of innovative programs that are new, that are emerging, and that we're starting to close deals with and help our consumers here at Exit Realty. And we wanted to share those with you today with an actual expert from the industry who's doing this day to day, and that is Don Meadows from Regions Bank. So if you're looking to get into that first home, we are excited to share with you today. We have two really big focuses here at our office in terms of helping you get that home or investment property. I'm here in my kitchen today. We're doing a little bit of light rehab work at my property. And what we know for all of us is we're trying to get that mattress money first. We're trying to get that investment property or home that you sleep in at as your primary residence. You're trying to get that place for appreciation. You're getting the opportunity to get those tax benefits on your primary residence. And you're also, once you get that mortgage, paying down on that mortgage every month to help build that nest egg and that legacy for your future. And once you get this first property, hopefully eventually you'll think about not only that mattress money concept, but also mailbox money, maybe getting another property down the road. Maybe your first property isn't the one you're going to stay in forever, or maybe it is the one you're going to stay in forever, but you want to buy more property and build, again, that legacy for your future, for your family's future, that income, that cash flow potential, as well as the long-term appreciation. And as I just mentioned earlier, those tax benefits as well. So again, I'm your host today, but I am not your presenter today. Your presenter is going to be Don Meadows with Regions Bank. He's doing some wonderful things for consumers. One more note I will give you on behalf of all of us at Exit Strategy. We are excited about what's going on in the market right now. There's a lot of opportunities out there. We will continue to have these monthly events towards the end of every month. So look to our social media feeds and to your Exit Strategy agent for those. These are a hallmark of what we're trying to do with our consumer education as well as our realtor education. We're really passionate about doing this for all of you. So we welcome your feedback at the end of this today. I am going to, with no further ado, turn it over to Don, and he's going to take us through the rest of our time together this afternoon. So Don, in advance, thank you so much for what you're doing for our consumers. And for all of you out there that are consumers, remember, Exit Strategy has never charged a fee to consumers beyond commissions for our sellers. So our brokerage doesn't believe in any of those admin fees or hidden fees that some of the brokerages out there are charging. That's something that I'm personally very passionate about as the owner and the coach. And I know our agents, as owners of their own business, are really excited about what that means for you as well. So Don, I'm going to turn presenter mode over to you and turn my camera off to get that going. So thank you in advance. Thank everyone for being here.
You're muted.
It's not doing the screen share. There it is. Thank you, Nick.
Thank you. There you go, Don.
All right, everyone.
Perfect.
There we go. My name is Don Meadows with Regions Bank. I'm the area manager, production manager, and I specialize in CRA lending. And for you to not know what CRA lending is, that's Community Reinvestment Act. Every bank and every community is required to do CRA loans. And for regions, that means that we're making affordable housing for people that are looking to buy a home. And you don't necessarily have to be a first-time home buyer. What does that mean for us? A lot of folks are in the mindset that first-time home buyers are people that haven't owned a home in 3 years. The concept has changed. You can currently be in a home and in the process of selling your home because that was your starter home, your family is grown, or you're downsizing. We don't punish folks because they're changing their lifestyle. And home ownership is a huge transition to make for a lot of folks. So we had to create an affordable product. And for us, that meant that we took into consideration what was going on in people's lives. COVID's hit in the past year, and it's affected everyone tremendously. Even prior to that, there were always down payment assistance programs, but we had to focus on the customers first. And we learned by doing that, seeing what programs were out there, but we had to create our own to create even more affordable housing. Because everyone's heard of FHA and VA and Freddie Mac and Fannie Mae, and you've got your different IDA products. We're familiar with those as well, and we do those as well. But we created a niche for what we call our portfolio lending. Because we're a bank, not a broker shop, we're lending our own funds, and we service our loans. So the only loan that we actually won't service are IDA loans. We do an IDA loan that have to go to U.S. Bank for servicing, but every loan that we generate, we keep as a customer because we're looking to create a whole relationship with the customers that we do mortgages for. And how do you do that? Portfolio lending, and by lending our own money, we get to provide you with financing on low to moderate census tracts, which means targeted areas where low to moderate income exists. And because the census hasn't been done or executed, has been completed, and it won't be in until later part of 2021 or the beginning of 2022, areas that people don't know are in LMI census tracts. For example, Bronzeville is an LMI census tract, all of it. From the South Loop from 22nd in Michigan all the way to 91st Street is a low to moderate census tract. So what does that mean? That means if you can make $600,000 a year, if you want to buy in that area, it's classified a low to moderate area. And for that, I can provide you with 100% financing with no mortgage insurance, no down payment required. Now, if your income is 80% of the median income, which is for the Cook County and the majority of Illinois, is $72,800. In that aspect, I can provide the same program for you anywhere in the 23 states that we do loans, because you automatically qualify. So it doesn't have to be in a low to moderate census tract, but you have to have a minimum of a 620 credit score. And this is a manual underwrite. So there's no DU or LP run up top processing. It's not an automated process. We do a manual review. If you had no greater than 90-day lates in the past 24 months, you've been out of a bankruptcy for 4 years, foreclosure for 5, that's all we're looking at. Any collection accounts have to be paid, no charge-offs. But if you got a 620 score, I can give you 97% loan to value up to $549,000 with no mortgage insurance. And the rates are actually reasonable. The rate as of yesterday was 3.25%. If you have a 680 score, I can give you 100% financing with no mortgage insurance. And it's only for single families, condos, and townhomes. So when you take in consideration what are you doing, how do you get this program, low to moderate census tract, or income below $72,800. Single family residents only. No 2s, 3s, and 4s. And of course, there's no MI. It's a lender paid MI, so there's no MI. In addition to this product, we can get up to 6% in seller contributions, similar to FHA. So if the seller wanted to pay 6% in closing costs and you have 100% financing, you got more money than you can use. And remember, guys, sellers can only pay closing costs. They cannot pay down payment. So if they give us 3% in closing costs and it's more money than the actual closing costs incurred, we have to refund the seller back the difference. We cannot cut a borrower a check. I keep telling people that there's no such thing as extra money in a closing. So in addition to that, I don't know how many people have heard of the income-based repayment plan, because this is a portfolio product, and a lot of customers that I deal with have student loan issues. Student loans are preventing folks from buying a home, and they normally wouldn't qualify through Fannie Mae's products to purchase because of high student loan debt. But with our product, because it's a portfolio loan, being our lender's money, we can do a zero payment on student loans if they're in an income-based repayment plan. But they have to be in an income-based repayment plan. Deferment doesn't count. Not for this, because we view this loan and we treat it the same way you would a Fannie loan product. And Fannie allows for an income-based repayment plan, so we allow for an income-based repayment plan, which creates more affordability for homeowners. Because the average student loan debt right now in the minority communities, they're greater than 35% over their base income. And that being the case, they would qualify for 15% of their gross monthly income maximum as a payment, or zero if it exceeds their base income. And I can send out the information on how to apply and the different criteria for income-based repayment plans, but it is set up for a 25-year repayment structure, and what's not repaid after the 25 years is forgiven. But we can get into that later. It's talking about different structures for these, but this is called our Affordable 100 or 97 program. The only difference between the program is the credit score. The interest rate's the same no matter whether you have the 690 or 620, our score stays the same for our customers. And of course, they're allowed to buy the rates down. Our next program is our doctor and dentist loan. Doctor being an MD or a dentist or an orthodontist. We've done 100% financing up to $750,000. And if it's a condo, we've got to do 95%, but it's still like up to $1 million with no MI. Now, there could be future employment. They could have just graduated from medical school. They haven't even received a paycheck yet. As long as they have an offer letter, we can complete the loan. And same aspect, because they are not making the money that they normally would be making as a tenured doctor, we'll still do the deferment and use the income-based repayment plan for their student loans. So we look at the fact that they're going to make money as a doctor, and we'll give them a loan. $750,000, 100% finance. For a condo, we do have to do the 5%, but for a townhome, single family, 2 units we will do this depending on the situation. So it's a case by case on the 2 unit, but 3 and 4s are not included. Now, in this, we also look at different, what they call emerging professionals. So we look at attorneys, physician assistants, nurse practitioners, chiropractors, veterinarians, as long as they're in the first 7 years of their profession, and they're not, well, they could be self-employed. Well, I'll take self-employed. As long as it's within the first 7 years, we'll give them 97% loan to value up to $750. And if they go up to $1.5 million, we'll do it at 95. For physician assistants, nurse practitioners, pharmacists, veterinarians, podiatrists, even chiropractors. So, and once again, student loans can be deferred for 12 months or greater, or in an income-based repayment plan. And for this, we're trying to help starting people in their new profession and recognize that they're a professional, and we want to help them. And we want to also look out for our, first-line responders, so they're getting the benefit of some of the programs that everyone else is getting. We also have a non-conforming jumbo loan products. We can go up to $4 million, but for all intents and purposes, $2 million. The average $4 million is an off-sheet pricing, which means we can still do it. I just know the size of the product and what the person's contribution is going to be. We do investor loans, second homes, up to 650. Did we lose the connection?
We can see and hear you, but you just need to share your screen. There we go. Don, you need to unmute yourself, please.
Sorry, I muted it.
There we go.
Yeah, sorry, don't know what happened there. We also do new construction renovation, and we have a jumbo renovation program allowed with this product. So if you have a property that's in a distressed area, but it's a high-end area and it's over the median income, we will provide the renovation loan for that. Excuse me. We did one in River Forest. The property was $500,000 acquisition. We put $400,000 in renovation costs, and we do the subject to. So it's similar to a Fannie Mae home style renovation product for owner occupied or second home or primary homes. We will do this jumbo renovation. And I don't know many folks that are doing that, but we will allow you to do a jumbo renovation. Certain condos have to be reviewed. They have to be warrantable to allow for a jumbo renovation. So if it's a non-warrantable condo, we can't do the jumbo renovation. And for this product, we can do a fixed or adjustable rates. But there is an upfront rate lock fee for this of 0.5 point for an extended renovation term. Now, you know your basic conforming loans, that being Fannie Mae and Freddie Mac. We, of course, do these programs at the 97% for first-time home buyers, as low as a 640 credit score. 2 to 4 units, as of recently, Freddie Mac is no longer doing the 5% down 2 to 4 units as of January 21st. They are now requiring 15% down, the same as Fannie. They were doing it, all of it, and we try to get as many in as possible. But after January 21st, Freddie Mac is no longer accepting 5% down for the 2 to 4 units. The non-occupied co-buyers are allowed up to 95% loan to value. Gift funds are, of course, allowed. And the first-time home buyer programs with no closing costs are eligible. So the Freddie Mac and Fannie first home programs are allowed, and we accept any down payment assistance with these programs in addition to this. Of course, we do the VA loans. Up to 100%. VA has removed their purchase limits, so you can do a VA loan, a single family up to $2 million with a 580 credit score. There's no more purchase restrictions on VA as of January 2020. So if they're a veteran, they can do a jumbo loan with VA. And that's from 1 to 4 units, no minimum. Now, IDA does have restrictions. First-time home buyer restrictions are waived for veterans, and it's also allowed for their spouses and widows. Of course, we do FHA and USDA. The purchase FICO on FHA, we actually just dropped it to 620. And for that 620, we cap 600. We cap at 43% DTI. They have to be at 640 for us to go to 50% of the DTI, the debt to income. We do a manual underwrite with no credit score at all, as long as they have alternative trade lines. And we will do the rental income to qualify for the 2 to 4 units, but they need a 640 credit score for the 2 to 4 units. If you happen to do a USDA, I don't know if any of you on the call have ever done one, but we do USDA loans with a credit score of 620, which is 100% finance. That's more in Southern Illinois and Indiana, but we do USDA loans. Now, we are currently doing all of the IDA programs, be it the Open Doors, the Smart Buy, all the IDA access programs. So the most popular today is the Smart Buy, where you're getting up to $40,000 in student loan payoff, but it's for Fannie Mae only. And you have to pay off all the student loan debts at the time of closing. So, and we can mix it up. So if you got two people purchasing and one owes $30,000 and the other one owes 10, we can pay off the one that owes 30,000 student loans in their entirety, and the other person doesn't have to pay their loans off. But if it's only one person, that one person has to have their loans paid off in their entirety at the time of closing. So if they got $41,000 of student loan debt, they're going to get $40,000, and they have to come to closing with another $1,000.
Hey, Don, we can't see your screen again. I don't know if maybe you lost connection. You're also on mute. So we just need you to reshare your screen.
There you go, sir.
It just faded out. Okay. For the IDA program. So if the individuals have a $40,000 in debt or $42,000 of student loans, IDA is giving up to $15,000 per $100,000 in loan amount. So if they had $200,000 home, IDA will give them $30,000 towards their student loan debt payoff. And if it's two individuals on the loan, we could pick which one's loan is going to be paid off. But if you only have one individual, someone's loan has to be paid off. It cannot be both. And of course,
Hey,
purchase
Don,
limit.
someone's
Yeah.
asking what is the limit for their income for the IDA?
$109,200 for a single family or two.
I think there's going to be a
109.
session afterwards.
Yes, 109,200 for IDA loans, as long as there's not using the mortgage credit certificate, and which currently are not available. IDA income and purchase limits, IDA single family is $334,000. That's the most you can do. And that means that you cannot buy $340,000 and put $6,000 to reduce and finance the difference. The contract cannot exceed $334,000. The same with the 2 unit. The maximum purchase amount for a 2 unit for IDA is $418,000. You cannot make up the difference. The contract cannot be greater than $418,000. And of course, for IDA is the only program we have left that you can put 5% down on a conventional loan for a 2 unit. Now, this is just to give a chart, and I've shared this. You can have it just for review, to show how student loans are reviewed per lender and per guideline for the program that they're going through. Fannie Mae allows a non-amortized payment, which means they will allow the income-based repayment plan even with a zero payment. That was updated as of April 2017. And of course, the fully amortized payment, that's a payment that pays the loan off for a certain amount of time, principal and interest, is allowed with all lenders. If the loan is in forbearance, it's counted at 1%. So Fannie Mae is the only standard lending program that allows for a zero payment with the income-based repayment plan. But all lenders do not accept a zero payment. And it depends on what their overlay is. Fannie Mae stopped doing a zero payment as of November the 1st, 2018. They want to see a payment. So they'll let you do half a point versus 1%, but they will not allow a zero payment in income-based repayment plan. So they're stopped allowing income-based repayment plans. Fully amortized payment, of course, is okay with all lenders with a Freddie Mac loan. Deferred or in forbearance, unlike Fannie Mae, Freddie Mac will do a 0.5%. So it gives you some leeway if you have to go conventional on the financing, and it won't count it as 1%, and they don't qualify for an income-based repayment plan. FHA, which is the strangest thing to me, should allow for an income-based repayment plan, does not. And even though a fully amortized payment is allowed, they're always going to defer to the 1%. That's just the guideline. It's going to be 1% of the student loan or a fully amortized payment, whichever the two is higher. So most lenders just started to defer to the 1%, and FHA allows us to do that. If it's in forbearance, it doesn't matter whether student loan is being paid or school, it's in forbearance, or even you're in an income-based repayment plan. FHA is now, since 2015, is 1%. And that's how it's counted, at 1%. VA, non-amortized payment is allowed because if your loan is deferred for 12 months, VA will not count your student loan debt against you. So the veterans got it easy. 12-month deferment, student loans are not counted, period. And it's still, of course, 100% financing, 1 to 4 units. And that's including condos and townhomes. Currently no mixed-use purchases with VA, but we can do a mixed use on FHA, up to 4 units, as long as the residential property is greater than 51% of the square footage of the place. So, Regions as an organization, we're about $125 billion in assets. We're the 15th largest bank in the country. Corporate offices in Birmingham, Alabama. We've got 1,500 branches around the Midwest. We live in 24 states, and 40% of the loans we do are our own loans. So we do a lot of portfolio lending because we have the ability to make decisions that are off the books. If it makes sense, we will do the loan, which gives us a little bit more leeway. We service 99% of the loans we do. We have a fintech 25-year, 24-hour, 24/7 real-time loan status, digital signatures. The customers can track their loan status online. And we have actually branches in Illinois, but they're in Southern Illinois. The 2 locations we have here in the Chicago market, we are 10 South Wacker on the 25th floor and 903 Commerce in Oakwood. So we do a business pre-tax provision income, average loans, and deposits. Of course, as a bank, we do not force people to open up deposit accounts, but we are looking, we do have programs that they give a little incentive if they open up a checking account. A prime example on one of our accounts, because of the type of leeway we have on the portfolio product that we mentioned earlier, if one of your customers were getting a gift from family to do the 3% down payment, I will give them 100% financing and let the person keep their money. And I'm going to say that again. You have a customer with a 620 score. Their family member wants to give them the 3% down. I will let the family member keep their money. I will put it in a CD, and I will give that customer, even with a 620 score, 100% financing. And once the customer's paid down the loan to 97%, I'll release the CD. And I'll do that on any of our portfolio products. If they get a pledged asset from family, the family can keep the money. They just have to open up a deposit account with a CD that I can trace, and I'll give that person 100% finance. Flexibility with our money. That's what we call it. And it's just a common sense lending approach. When you rather have 100%, the person, you're more than likely to get down payment assistance from a person if they don't have to. Most folks pay it back after closing anyway, one way or another. We know that. This way, the person is giving them the money, and they keep their money. Pledged asset. And they'll do that with any of our portfolio products. So, and Nick?
Yes, sir. Yes, Doc.
I skipped past the Smart Solutions on here. It's one of our non-QM portfolio products. This is for condo tails and burn homes. We normally don't do this in Illinois, so I skipped past it. But it's just so you know, we do a lot of this in the South. the burn homes, condo tails, horse farms. I didn't bring it up, but for this loan, we do make some, I've done a couple here in Chicago for cross collateralization. For folks that didn't have the money, I'll use the equity in one house to help you build another one, and you don't have to refinance. I'll just put a lien on the other house.
No, I love this creativity.
Yeah, so it's just a matter of, it's a minimum FICO score of 89, of 680. But in this program, most lenders will do whoever has the lowest credit score. You guys see that, right? Somebody got a 700, and the one with the money's got a 615. But you got to use a 615. I will use the highest credit score on this loan because it's our money. So if you got somebody with really good credit and they got somebody with really bad credit, as long as they can put 11% down, I'll use the person with the bad credit. I mean, with the higher credit score. And that's the score we'll use as the middle score. As long as that person income, hear me out on this, their income is equal to the mortgage payment. So they can be on Social Security, making $2,200 a month, and the mortgage payment is $2,000. That income is greater than the payment. I'll use that score and use the person with the lower credit scores income. But we'll run it like we had an 800 score, or whatever that higher person score is.
Don, we had a question about educators. So teachers, people like that. Do we have anything for them?
Currently, the city of Chicago was supposed to come out with something else. I forwarded something. Ron, I sent you that thing with they changed the first responders program, and they're coming up with something later, the latter part of this year. But right now, their money is tied up in the COVID disbursements and getting the schools in order. Because it was supposed to come out last year, but it hasn't come out yet. They had a $3,000 and a $7,000 program they were implementing, but I don't know where they are with that. I'm going to have to follow up with the Department of Housing. I know an individual down there is doing over the programs, and I'll follow back up to see what they're in. But right now, no. There is a City of Chicago program, though, and it used to be the first responder program. Now it's the community lending program. And it's for firefighters, police officers, paramedics, and people in the Union Local 1092 for the City of Chicago and 1001, which is the water department, streets and sanitation, aviation, and the bridge.
Okay, thank you. And then let's go ahead.
$30,000, by the way.
Okay, Don, if you're ready, let's go ahead and open it up for questions. If anybody wants to unmute themselves, this would be a great time to do so.
Hi, I have a question.
Sure.
Do you have any non-owner occupied programs for investors?
No, ma'am. I mean, for the most part, we'll do an investor purchase, 15% down for a single family and 25% down for a 2 to 4. But other than that, not really.
Okay, great.
And that's
Thank
basic
you.
Fannie and Freddie. Sorry.
And what kind of rates do you have?
Oh, well, our rates are excellent. So for which type of product?
Single family.
So from top to bottom, FHA, we're at 2.375 FHA, 2.5 on VA. Conventional financing all depends on the credit score and the loan amount. So it's difficult to say just spit out a conventional rate like some people like to do, but I can tell you what my FHA and VA are. If you have a 700 credit score, I can get you about a 2.75 with 5% down on a conventional. If your score is lower than that, your rate's going to be worse.
Okay, so like okay, great. So at about a 715 credit score for 175,000, 200,000.
Yeah, you'll easily be at about 2.75%.
2.7.
I can do that. Even if I have to make it that, because I said it out loud in front of people, I can make it that.
Okay, great.
But in addition to that, depending on the individual what their credit score is, I may be able to do the 100% financing, and you have to weigh that out because if I can give you 100% financing at 3.25%, because I know what that rate is, the
Okay.
payment's going to be lower than it would be at 2.75% with putting 3% down.
Oh, excellent.
Because there's no MI. And the customer's saving the down payment amount because having to go through the grant and see if they qualify, the hiccups with DU, because DU and LP, Freddie and Fannie have not been nice to people lately.
Okay, great. All right. A refi? Okay, one more question. What? A refi for an investment?
Don?
Yeah, I'll refi investment property up to 4 units.
You say a refi is what now?
I will refi investment properties up to 4 units. I'm currently doing a refinance for a guy's 3-unit on Laughlin. It's a 3.375% for a 3-unit, and it's an investor 3-unit.
Okay, great. Thank you. I'll definitely be in touch. I appreciate your time.
Right. Not a problem.
And Don, I just wanted to make one comment. This is Nick. One of the things that I find right now, I'm getting a lot of questions on what are the prices going to be for consumers that, are property prices going up? Are they going down? And what I can say for sure is that, we don't know where the future holds in terms of property prices. We don't foresee anything like that great market crash of 2009 and 10, where, a lot of people suffered and prices went way down. But we do know interest rates have never been this low and probably will never be this low again. It's really, the banks are basically losing money almost when you go to interest rates below 2.5%. So, if prices go up a little bit, you've got a long-term investment piece with interest rates this low that you're never going to see again. So you really only have 2 opportunities in the market. Opportunity number 1 is price. Opportunity number 2 is the term and the rate of your note. And, my first investment property in 1998, when I got my real estate license, my interest rate was 9.25%. And that was pretty decent at the time. So, we remember 6, 7, 8%, 9% interest rates over the last 20 years. And so these are just incredible. And it's hundreds of thousands of dollars in savings from a lot of people.
Yeah. And I don't want to age myself.
Don?
My first house was 11.5%.
Yeah, it's crazy.
Hey, Don,
Yes, sir.
do you lend in Florida?
We lend in Florida. We lend in the only states that I currently don't lend in the Midwest and the South. I don't lend in Michigan until July, and I don't lend in New York, New Jersey, or Philly. But from the center of the U.S. all the way down to Texas to the East Coast, I'm good.
Sounds good.
But
And what is IBRP? What does that mean?
Income-based repayment plan.
Okay, great. Thank you.
I abbreviated it for myself because it takes up a lot of space, and I try not to put a lot of words on PowerPoints. But it stands for Income-Based Repayment Plan. And Obama started it in 2009 to give different options versus just deferment and graduated payment schedules. So we came up with 4 options called the Income-Based Repayment Plan. They're now called income-driven. It's income-sensitive, pay-as-you-earn, and the income-based review. None of them are allowed to be greater than 15% of your gross monthly disposable income. It's a 25-year repayment plan, and what's not paid off after 25 years is forgiven. The bad part about it is if you have a 0 payment for consecutive years, you are accumulating interest. But the good part about it, if you stay on it for 25 years, it'll be forgiven. But if you make more money, you have to recertify every year. So if you only make $30,000 and you got $70,000 in student loans, you're going to have a 0 payment. And you're going to have a 0 payment till your income catches up with your student loan debt. And once that occurs, they'll start applying payments in reference to what you make.
And then the interest is carried to the end and after 25 years forgiven.
That is correct, sir.
Thank you. I appreciate it.
Not a problem.
Don, this is Nick again. One more question from me. If people want to know for the program, some of these programs obviously are for every area geography wise. For the programs that are involving the census tracts, is there a map somewhere or is that something that you want to go over with them individually?
I'd like to go over with the realtors individually, so they have a better understanding, because the realtors can go to the FFEIC, the Federal Financial Income Environment Center. It shows Google mapping, geocoding, and you can put the address in, and it'll come back and it'll say the low, moderate, upper, and it'll tell you if they're moderate or below, the house qualifies.
And by the way, everyone, for the consumers on the line here, I had an impression that was wrong when I was first starting to do some of these loan programs with some of our lenders, that, it's only in certain, areas that are really struggling right now. I was shocked at some of the income, some of the areas, the census tracts, like, for example, just north of me, I'm on the north side of Chicago on the lakefront. There's a census tract in 60640 that has had a lot of my clients in there getting a huge amount of overlays on the grant programs, things like that. We had some exceptional transactions over the last 2 years for my buyers in some wonderful areas that you would not think are subject to these. Somebody asked what the overlay is. The overlay is that's the areas that the census tracts that they have laid over with these loan programs, that they have decided to use these loan programs in, some of them. And remember, a lot of what Don's talked about today, guys, is not just for certain census tracts, for all census tracts, for every area. But there are some programs that are trying to really help boost home ownership even more so. And those are those overlay areas.
You have
Right.
some
So, for
great
example-
programs. You have some great programs, Don. I'm just wondering how long it takes you to actually close transactions.
Lana, how long does it take me to close a transaction?
Overnight.
Overnight. All right.
Don't do that to him.
No, we have not had any issues with closing. I think we had one that went a little longer, but it was not because of Don, it's because of the clients. So if they do what he tells them to do when he asks them to do it, and we need to stay on these clients to do that, then we're closing normal time. I don't know. I guess I would say we averagely are around 45 days.
Okay, so we're about 45 days. The other
I'm
question
guessing-
I have for you was in regards to condo projects. How low do you go on condo projects? Purchase.
How low?
How low?
Well, we're a bank, and a lot of I want to help you guys with this. As a bank, we cannot restrict a purchase amount if it's going to be owner occupied. No bank can, but a broker shop can. So as a bank, if it's $10,000, I got to do it, as long as it's habitable. I got to do it.
Okay, very good. And one more question, and I'm really out of the way. Do you do mobile homes?
Do I want to do them or do I? I'll do them.
Okay, so are there challenges with mobile homes?
It's always a challenge with mobile homes. Tag's got to be permanently fixed to the ground. Deed has to be retired. FHA tag front and the back. Problem is, half of them aren't done correctly. And then you have to worry about the lease holdbacks, because a lot of folks are trying to do the mobile home and don't own the land. So, yeah, I do them. I'm from the South. Baton Rouge, Louisiana. I do mobile homes. It's just they don't do them well here in Illinois.
That's, and one more thing to add to kind of Lana and to Don's point. Well, I'm from Indiana. We got a lot of mobile homes attached to land. So that's how I got my start doing real estate with some of those transactions. But, Don's cell phone number's on here. He's responsive by text. You've really got to find a lender that's going to be responsive to you, whether you're the agent, the realtor, or the consumer. And, having agents on our call today, we're trying to vet people for you. Not just lenders, but in general. So you're not going through the process blind with people that we haven't tried out either. So that's why, we selected Don today, why we selected some of the other lenders and attorneys you see on our webinars and our consumer education. We want to make sure they're good. And so, Don's kind of held to a higher standard with us because we're putting him, in the public view, and he's been doing some good stuff for us.
Right. And my assistant's information is on here as well.
Hey, Don, it's Cassandra. So really quickly, thanks, Lana, for the connection. Really good information as well. So I have a question. You already answered about the Community Connections Program, which is the City of Chicago's $30,000 forgivable loan program. What about, and you may have answered this, I had to pop off. What about the Micro Market Recovery Program? Can we layer that with programs?
I'm not doing it because I'm not giving NHS $5 million. I'll just say it out loud so y'all can hear it. I'm not giving them any money. So no, I can't play.
Okay. Okay, that's all I need to know.
You got to give them some money, and I'm not giving it to them.
Well, okay, I won't go into that, but
it's not a swing. They're a nonprofit, so they need money to stay in operations, and they get this grant money, but they want to be on their list. They want contributions, and I'm not giving them any money. I'm not swinging on them. I love the guys. I'm just not giving them money.
Got it. Okay. Well, thank you for the information.
We appreciate the transparency on that too.
Can I ask a question, Don? Can I ask you a question?
Sure.
Okay. Are you able to qualify dispensary workers? Because I know some banks can't do that.
Yes, you can. Dispensary workers can do a Fannie Mae loan. Dispensary workers can do a Fannie Mae loan. Fannie Mae allows for dispensary workers to purchase. Now, FHA, the Fannie Mae, yes. And my portfolio product, because it's my money. So, yes.
All right, guys. Go ahead. Keep going, guys, with questions. We got time.
I've got a question.
What you got?
Oh, is it hi, it's Evelyn Woods. Can you repeat what you said about the non-warrantable condos, financing for that?
See, non-warrantable condos, prior to COVID, we would do a non-warrantable condo. So when Fannie stopped, we stopped. So if they're not putting down 20%, just doing a regular purchase, and it doesn't qualify as a warrantable condo, meaning that it doesn't have the minimum of 10% in reserves, they have greater than 20% in delinquency, they're currently in some form of litigation, we're not going to do it. And I can tell you that up front. It has to be a warrantable condo. If it's not a warrantable condo, I can't do it.
So realtors, get that information about your condos. Make sure to get that information about your condos up front, whether you're the buyer's agent or the seller's agent. That's pretty key.
I have a question.
Don, this is Lana. I wanted to let people know about the student loan program. To me, before our conversation today, was not working for a lot of people. And I just wondered if you could give those examples you gave to me of deals that you did, because I hadn't seen it working for my client, but the way you explained it shows it can work.
You're talking about for the $40,000?
Yeah,
the $40,000 forgivable. So yes. I have a customer, right, that we just got to clear the close yesterday, so she's a little happy. She's buying a $180,000 home. She's using the IDA program, the Smart Buy. She has $27,500 of student loan debt. The Smart Buy is giving her $26,555. She has to come to closing with the difference, which is a little over $900 to pay off her student loan debt. Now, the $5,000 she's getting from the Smart Buy, she has to pay back whenever she closes, but that $26,555 is forgiven after 3 years. So,
and that is huge, everybody. You should really be thinking about that program, because that's student loan debt is one of the #1 issues we're having with millennials, even some of us Zennials that are around, that are carrying that loan debt from a long time ago. It's sad, but that's what we're talking about a lot. So that is a very unique program. And Don, could you one more time give us the outline quickly of that program? I'm not sure if you want to share that screen again, if you've got one on Smart Move, but we've talked about it before. But just give us the quick overlay one more time on that, those hoops to jump through for that 40,000. Okay,
so of course you have to have it's got to be 45. It can't be greater than 45% on your debt to income ratio. Debt to income meaning the money you make versus the debt you carry. Minimum credit score of 640. I'm going to put a quick disclaimer. I should have put brackets over the 640. I have not seen a conventional loan that got qualified with a 640 credit score in the past year and a half. I'm just going to say that. Even though the minimum requirements are a 640, I have not seen a person with a student loan debt get qualified with a 640 credit score. I have not seen it. I'm going to say that first and foremost. And I've checked with other brokers, lenders, and I'm at about 10 people so far has confirmed with me, nor have they.
Hey, Don, it's Cassandra.
Yep.
I was just gonna say, no, that's right. I haven't either. Just sharing that. I haven't seen anybody that's been successful under 640.
Yeah, I mean, it just doesn't work. The $40,000 is $15,000 per $100,000. $200,000 loan, you're getting $30,000. $250,000 loan, you're getting $37,500. The cap is $40,000. Any amount of student loan debt that is not paid off at the time, not paid off by this loan, must be paid off at closing. So it's not good for anybody unless they've got some money up and they got $10,000 in the bank and they want to pay off their $50,000 student loan. They're going to get 40 from us as the lender, and we get reimbursed through IDA, and then they put up the 10,000 themselves.
Okay. Or it would be ideal though if they did have right around that 40,000 or less.
Oh yeah, 40,000 or less, and that's a good. And honestly, guys, that's about a third of my customers have 40,000 or less in student loans. The other 2/3 got some real student loans, you know, 6 figures, especially my school teachers. My school teachers are not being treated fairly. Their student loan debt, even though they get paid well, does not match their income. So in those cases, that's when I use my portfolio products because it's difficult to get them through the process with the amount of student loan debts that they're carrying.
Don, one more question on that, and then I'm done with my questions. I think we can wrap up here pretty soon. What is the, is there an income limit on that smart program?
It's $109,000.
Okay.
Now, we met with IDA yesterday. We had a nice long talk with them. So if you have a customer, because although they need 3 years of tax returns, if they're over income with bonuses and overtime puts them over 109,000, let them come anyway, because we can get them qualified if their base income is below the 109, and the only reason they're over is because of overtime and bonuses. IDA will accept their base income. And remember, IDA is no longer counting household income. They're only counting the person that's applying for the loan. So
Okay.
109, 200,000, purchasing individuals' income only.
All right,
that's
thank
not
you.
Overtime and bonus.
All right, guys, we got time for maybe 2 to 3 more questions.
I have a question. Kathy Zaveda.
Yes, Kathy.
So
Hi, Kathy.
I'm out in Joliet, Shanahan area. I saw 2 numbers, yours, Don, and someone else's. Whose contact information would I give to my clients?
You can give it to myself or my assistant. This is Lynn Shermerhorn. She's my assistant.
Oh, okay. I didn't know if it was another.
Yeah.
Okay, because I didn't know if you were just Chicago. So.
Oh, no, I'm Chicago, Indiana, Wisconsin, Ohio. If you got somebody in Florida, I'll do Florida. You know, we're back.
Okay.
You know,
I do have one more question. I have a nurse friend that owns a house in Streeter, Illinois. She's been there 20 years. I believe it's paid off. She wants to move to Mississippi and have like a no down payment. Is that something you can give her information?
Yeah, most of Mississippi is a target area, believe it or not.
Okay, so I can give her your contact information?
Yes, ma'am. Either mine or Lynn, or you can email us both. Email or text is fine. This is Lynn's cell phone number. This is my cell phone number.
Thank you.
All right, guys. Any other questions?
You cited a website when you were talking about, I think, census tract areas or something. You cited a website that you could go to.
Yeah, I said FFDIC.
FFDIC?
Yeah, it is. Let's see if I can pull it up for you. Geocoding map.
Yeah.
FFIEC, I'm sorry. Geocoding system, federal financial institutions. This is what all the banks use and the federal government.
So it's F like Frank, F like Frank.
I as in ice, E as in echo, .gov. FFDIC. And it'll bring you up to this map right here, right? Can you see this map, Sarah?
Could you share your screen again?
Let's see. My screen.
No.
No.
There you go.
You said
You see it?
FFDIC?
E like Edward.
FFIEC, I'm sorry.
FFIEC.com.
.gov.
Okay.
.gov. FFIEC.gov. I'm going to test that out and put that in the chat for those of us, because this is being recorded and we will have the chat notes in here too on the recording. So I'll put that in there in just a second, guys.
All right, can you see my screen?
Yes. Yes.
All right. So give me an address, any address.
7210 South Crandon.
Okay, battery's low.
What's she doing at 7210 South Crandon? That's our backbone. Oh, you heard that address too. I'm like, what's she
She didn't give
doing?
any address, so that was the first one you
So
came
it says
You can hear?
it came up. It gives us the census tract information. It's moderate, so it qualifies. The tract median income is 50% of the median income. The average household income, 84 and 8, 32,000. So it's a moderate, so it qualifies. So the house qualifies regardless.
That's the
They can have
house.
any income.
Thank you. All right. Thank you, Dom, for that example. Well, guys, we are coming up on our hour here. Anyone have any other questions for Don? You do have his contact information now. All right, ladies and gentlemen, thank you so much for being here today. This is our monthly consumer education series from Exit Strategy Realty. We are here for you. We are here for you, whether a realtor, buyer, seller. A lot more to come from us, so stay tuned to our social media feeds and your agents. Don, thank you again. A huge amount of information for an hour and on a Saturday afternoon. We really appreciate your time, everyone, today. Have a good one.
Thank you for having me.
And Don, you do need to return off the, you'll end us here.
Okay.
Bye, guys.